Okay. Here's the story. I completed a class and I got some, how about constructive criticism on the way I dealt with corporate PPAs. And it was suggested that I make get more into the explanation, use real data, real prices, instead of just going through some general kind of things and even going through a corporate PPA contract, with the liquidated damage of the pricing and where the settlement point is and all that language you have in the PPA. It's suggested that I kind of do something more. Now I'm going to start in the middle of these slides. So these slides are, let's find it here. These slides are on this. Just a minute. Is this? Yes, it's right here. It's in the courses, and then exercises for the electricity analysis. So there's some more basically PowerPoint slides, and more importantly, some case studies in Denmark and in ERCOT, and I'm really going to work through some of this in more detail. So if you're not interested in corporate PPAs and merchant prices, you certainly do not want to watch this video. Please, turn it off now. Now, if you are interested in, let's see what I can do. So first of all, there was kind of a question. Well, what's this long-run marginal cost anyway? I'll start with that because I didn't explain it. This thing right here is called a screening curve. And if you have a different capacity factor, this is a dispatchable plant with coal that, how about we call large coal nuclear or something. We have three different types of plants. This one has a lower cost here. This yellow one has a lower cost from this capacity factor all the way down to about here. And then the base load plant has it here. And then what you can do is arrange those screening curves against the capacity factor until you just optimize, get the capacity factor until you just hit that little point here. Okay, you want to put as much base load in until you get this one, and then as much combined cycle as till you get this one, and the rest is peaker. And what that does is it leaves typically a very little bit of peaker up here. This will be the capacity factor where you count over the hours and the capacity. That's enough of that. And then there's a big issue with basis differentials. Now let me just step back and introduce this video. I'm going to go through some of the differences in the corporate PPAs. And when you say corporate PPAs, it's kind of a general thing. It's almost like PPPs, which is just whatever. No, it's public-private partnerships. Well, exactly what do they mean in different contexts? What's a corporate PPA? How much do we get into the forward prices and all that? Now, there will be basis differentials. And now one of the points I want to keep emphasizing again and again and again, this really nice man in the class told me, I need to understand the foundations before we get into all this crap about talking really fancy terms. I can't even think of it right now. A P99 hedge with a swap contract with a notional amount and a tracking account and a hedging program and a VPPA and a put option. Before we get into all of this, let's understand what we're really talking about. And when we talk about basis differentials, for me, it's not a hard thing. It's just transmission. And we need to understand the economic theory behind this. That's why I made that other video. If you want to watch more on the economic theory, on when merchant prices make sense or when they even don't, watch the other one. In this one, we're going to talk a little bit about transmission and basis difference. And the way I think about this is competitive kind of international trade. If you've got one country or area of the world that can produce something really cheaply, and another country that has none of it or has to produce it really expensive, the country that produces it cheaply should do more. And there's going to be some transportation cost. And that's exactly if you have one area in whatever, Texas, whatever, that has a whole lot of wind, and another area that has a whole lot of people, well, you want to transmit it from the wind to the people. You've got some cost of transmission. There will be prices in the two different areas. So you set up supply and demand. Everything starts with the supply and demand. And the supply and demand is one of these things. And there should be a demand elasticity for anything related to merchants to make sense. But I always use these flat demand curves. So in this case, we start with the red line. This is the high cost region. There was a price of 60 because this is the supply curve. Everything's driven by the shape of this supply curve. It still is. If you start talking about all this fancy crap without understanding that, you don't get anywhere. This one has more, maybe renewable energy, whatever, some more capacity down here. And here it starts with a price of 30. And if we don't have any transmission between these two areas, this will have 30 and this will have 60. But if we put more and more transmission in and allow trades, then this will be like reducing the demand in the high cost area and increase it in the low cost area. And if we can put this much transmission capacity, and then we still have a difference in the prices, or we can kind of put an unlimited amount of transmission capacity, which is a fixed cost, basically not a variable cost, a little bit of losses maybe, but just forget those. And you get the equal marginal cost, the equal spot merchant price in the same two areas. So there's a basis difference when you have that. Now, we'll talk about why that's important in just a minute. Now, now I'm going to go through just some forward price issues and different ways to set a contract for forward prices. And here we call these mid-streamers. One person in the class had this wonderful term. I loved it. These are people who will buy and sell energy and kind of make a little market. You know, I should tell you right now that these are not AAA companies necessarily. This one I think is triple B. You've got these companies that are supposed to make the market like a bank, and if they have a little bit of a dicey bond rating, it could be interesting. So we're going to talk about really what they do exactly and why you need them. Okay, and now, you know, I started talking about an interest rate swap before. Can you imagine? I've got a slide on here in a minute. Can you imagine going to the bank and say, you know, I want you to fix my interest rates? And then you say, but I don't know how much debt I'm going to have. Maybe I have 100 million, maybe 200 million, who knows? And now pretend the interest rates for some crazy reason are different in the nighttime and the daytime. And then you say, well, I'm not sure if I really want to hedge at night or the day. That's what we're doing with power. That's what a contract for a difference is trying to do. You're trying to hedge something where you don't know the quantity. Whereas an interest rate swap, you have something called a notional amount, and you have that in a swap for electricity. And you better understand that before you start talking in all these fancy terms, and before you go to goddamn Bloomberg and say, oh, they say the price is this, or level 10, and they say the price is that. So let's understand a little bit more what the different options for forward prices are in an electric market. And we could go, I hate all these things. A fully merchant, fine, we got that. You sell it at the place. Remember, if this is this transmission, you sell it here or you sell it here. And you can't produce it here and sell it here if there's no transmission. Okay, good. Then we can have a regular old PPA agreement, and most of us know about those. Those are contracts that have a lot of nuances in them. That's for absolute sure. And in those PPA contracts, we put meters in and we figure out how much power goes to the grid, and there's a grid owner who happens to be the off-taker who buys the power. That's what it is. There's some physical stuff going on as well. And then there's something called as generated hub PPA. What does hub mean in this case? Hub or node, that's this transmission basis differential. And as generated means you're going to get paid no matter whether you produce it in the day, in the night, and all that stuff. And you're going to get paid at the hub, not the node. And we got to go through that crap. And then there's a fixed volume commodity swap. And the fixed volume commodity, no, they say fixed volume. We have all these different terms. You call that notional amount, and you call it a swap and you call this one a contract for difference if it's as generated. Now, what we're going to do in this video, and it might be a long video, and I don't care. I'm going to go through some of these things slowly with some real examples, some examples with some real data, and I'm going to take Denmark and Texas, okay, for various different reasons. Texas, because that's where a lot of these people do these fancy little things, and Denmark, because the data is so much more interesting. Now, it's popular to put these different things in columns. If we start with merchant, we sell to the grid, we call it at the node. That's where we actually produce the power. And we sell all our power at variable prices, whatever they are. But that's why we want to understand how these prices are made. And the second thing, oh my gosh, if you don't go through history, if you go to Aurora or some who they are, I'm sure they're very smart people, without studying the history yourself, how can you study anything without going through history? It's so interesting studying through history. First, you see the bad things and the good things. You see what can go wrong. You understand what's going on, and then you say, okay, let's take all of that information and look to the future. Now, I try to put some risks. We'll talk about a tracking account in a minute. So like everything here, well, the price risk, you take full price risk. Quantity risk, if the wind is not producing, you don't get paid. If it takes a lot, you do. That's for all the cases except this crazy last one that I didn't introduce in the last one called a proxy revenue swap. I don't even know why this would even occur. Transmission risk we just talked about, and we'll talk. The node is a market, a supply and demand market where you're producing the power. The hub is more centrally located where you have liquidity and people can make trades. That's the fundamental difference. That's why they have it. Okay, and then we go to a bus bar, PPA. I've already kind of mentioned it. You sell at the grid. And then there's this confusion as to what really is a virtual PPA. This is kind of one you can talk about anything, but here we say you sell it. It basically just like the bus bar PPA, except you have you don't actually sell the person who's buying the power is not the grid off-taker. Okay, that's it. And then it starts to get interesting because then we could have and what I did, by the way, I'll this little matrix, if you want this silly little Excel thing, you can put it on the website, I think. So here, you can sell, if it's a contract for differences, you can sell it at the hub or the node, and you sell all the power produced. How wonderful is that? So you don't take any risk that you have to go out to the merchant markets and buy and sell. That sounds pretty good. And you could, here, the problem, there we're starting to get a little bit different. The person, so you're going to sell it to maybe a financial, one of these mid-streamers. You're going to sell it to one of these people. Okay, and then they might say it's a fixed price, a price that has a little bit of inflation in it, and you sell the difference. So if you produce some power, you get paid a fixed price. You sell it to the market at a variable price, you get paid at a fixed price, and they make it into a fixed price. And they do it on any of your volumes. That's great. And you might have transmission risk and you might not. Could have either. But the other thing they might do is they might make a price that's higher in the day and lower in the night. So they can't. It's incredibly difficult, I would think, to make a really liquid market on something where you don't know the exact amount of the output. And then we go to a financial hedge. And this one is generally when you when you make your contract, the contract is at the hub, and you sell a fixed quantity. You sell a quantity, and we're going to show you exactly how that works instead of just BSing about it. And then we have the last one. Okay, so let's see how they work. Now you could also have a put option, which is the right to sell at a fixed price. That's what any put option is. You stop and say, put, call, right to buy, put, right to sell. If I'm the holder of a put option, I have the right to sell it when the price, and if the price goes down, I can do better when the price goes down. So it protects us against low prices, basically. And it's just really a variant of this one. It's a variant of this one. Okay? So that's just a little introduction to really understand these. We're going to go through piece by piece. Now, this is not necessarily right, but these are some transactions, and you can see most of them are the red ones, which are the swap, which are the complicated one, because in this swap one, if you're going to fix the volumes, you don't, that's not the same as you produce, and you're going to have to take some risk when you promise to hedge at a certain volume, and then the actual volume you produce is differently. You're going to have to do something about that. You're going to have to buy and sell in the market. And when you do that, you're going to have to make this tracking account. This one is the interesting one, really, and the complex one, and that's what we're really going to go through a lot. Okay. Now, here's what somebody said. Here, this is a very big company who put this in some slides. They said this is a contract for difference. Allows without the hassle of physical delivery. Fine, okay. We have basically a financial intermediary, and we have to go really slow and understand exactly what that does. And it says, okay, mate, you have what you'd really have in a PPA. And then it says, if the price is above fixed price, will you pay? So here's the fixed price. And if the prices are above that, you pay. If they're below that, he pays. And basically, you're selling into the market at these prices, and by somebody else buying what you're selling and then giving you a fixed price, you're pricing. Any swap does that. And you can go through it slowly. It's worth going through it. But then it says they're based on notional fixed shaped output. Ooh, that's not what a contract for difference is. So I put this thing. It's just people throw these things out, and that's not what it is. You sell at whatever the output is. That's what I'm defining a contract for difference. If you want to define it somewhere else, something else, but really distinguishing, we got to get these terminology right. Sometimes you have notional power that you agree to. Sometimes you have varying power. Now, to really get into this, I thought this time, instead of just BSing around, let's talk about how you hedge prices and what goes on. Now, this, for me, I hadn't read this forever, and this is just a little blurb that NYMEX puts out. And they just say, what are futures contracts? And the very first thing they said, specified quantity. A contract for difference where you sell whatever output you have, that is not something that you would see on NYMEX. And then they talk about it over a month. And that's important, how we deal with the hour by hour and what's going on over a month rather than on an hour by hour basis. And then they say only a small number of contracts are actually traded. It's all financials. And they're made in standardized units, highly visible, extremely competitive auction. And to do this effectively, the prices must be volatile. Okay, yeah, electricity prices are volatile. There must be a large number of buyers and sellers, and they must be fungible and interchangeable. They must work with the same place, and each understands that the products will be changed over time. And basically, the buyer knows you need a liquid place. You can't just take one single little plant in the middle of a big windy place and say that's where we're going to make a market. That's the hub. There has to be a hub where things really get traded. And this is here. Here are hubs. These are hubs, and these little things are nodes. So if we put our wind farm here, we have the supply and demand that works over here, and we have to sell to the hub. There'll be a price here that's different than a price here. I don't know if that's good, by the way. I think the California crisis, where they had too many little prices in different places, really made a mess. I talked about history, and you need to. If you start reading contracts and are a really good lawyer, but you don't understand where these prices come from, I just don't see how you can do that. That's kind of the idea here. Okay, now here's what happened in ERCOT. Let's study the prices for a minute. And this is the hub. There's a hub price that's published. You go to this ERCOT website. I went to it, by the way, and they said, you're not allowed to go here. Screw that. Screw them, really. And this is the natural gas price and the electricity price. You can see this is month by month, like NYMEX kind of said to do. This is the historic actual price. Okay, and then that's the blue one. The red one's the gas price, and you can see this tight correlation between the two. Extremely. And this is a period from 2011 to 2018, which I purposely did. And if we look at heat rates, which you take the electricity price, divide it by the natural gas price, and when you do that, you get let's say it's USD per megawatt hour divided by USD per MMBTU. The MMBTU switches around, and you get whatever, cross, multiply, and divide. It was the 60s or 70s when I learned that. And you get, when you divide the electricity price by the gas price, you get MWH, or MWH per MMBTU, or you could convert that to kilowatt hours per BTU. Excuse me, BTU per kilowatt hours. Excuse me. Oh, God. And I should have said that right here. I should put always the scales, but it's just a pain to do that all the time. So these are the actual heat rates. And there's another video somewhere on another explanation of how to go and get that. But I put this file with all the historic prices here, and I should be updating it all the time, but it's a pain to update it every little time, so I didn't for this. But I purposely stopped here. And then we had that famous winter where people died, and it was just horrible. And ERCOT has this philosophy, and we discussed this in the class, and it's important you understand the underlying philosophy of this, that they have if you just have a natural gas plant or a peaking plant, you never make money. You need a capacity addition or a price spike, basically. And in Australia, they love price spikes. Well, I can't get the word out. In Texas, they love this price spikes, and then they got all blasted and said, you need to regulate this, you need to assure the amount of capacity that's there and make a capacity market. Because this is what happened. You had an enormous price spike, and then the heat rates, and these are the other price spikes they allowed. And if you don't understand how markets work and what's the basis for a capacity price, instead you talk about all this fancy crap all the time and fancy big terms. You got to understand why there is a capacity price. That was in the other video, and I'm getting very emotional. I'm going to have a heart attack, but I don't give a crap because it's so important to understand why these things exist and where they come from. So here's the heat rate, this boring old heat rate, and then it goes up. That's why ERCOT's a nice one to study, and that's why history's kind of a nice thing to study. And then you can go to NYMEX. You just, whatever, Google NYMEX and Google NYMEX gas, NYMEX ERCOT. Get the prices. And here are the forward contracts, and you can go forward, and you can do a little lookup stuff and do a little Excel and get the forward gas prices, get the forward electric prices, and then you divide them and you see what the market heat rate is. That's pretty cool. And these heat rates are far, far higher than this really boring heat rate here, that one. But maybe they're worried about some kind of price spike. You can understand that these things dominate the market. And how you'd price it in, I don't know. Who knows? It's kind of supply and demand. So these heat rates are a lot higher than just the natural gas heat rate, and they're different for different months. When they're boring months, they get down towards it and then higher. And here's what you can do. The natural gas is a very liquid market, and it goes higher in the winter than the summer. And then you can compare that to the electricity. The electricity was not liquid, and I don't even know how really liquid the other cases were, but we do have a transparent price. We do have something. And this is the electricity is the red one, and it goes up both in the summer and the winter. The natural gas goes more up just in the winter. So this is just the first few years of this. That's NYMEX. And that's the implied heat rate in NYMEX. Okay, so that's just a little bit of background to get us started. And that's what we're hedging. We're hedging these kind of prices. Okay, and we're hedging them at the hub, not the node. So now let's just work through this hub and node business just for a little bit and understand what's really going on. Okay, and first of all, like I said, I've already started with transmission, so I don't have to go through that. But this basis risk comes from transmission. If somebody's building a new transmission line in your area, that basis risk should go down. And who should take that basis risk really is a fascinating question. Should it be the off-taker who's buying the power? Should they take the risk of a new transmission line changing the market, or worse yet, a whole bunch of new wind coming in a particular area, which means that you might have trouble getting the wind out of that. There might be more constraints for you to get it to where you want it. Who should take that transmission risk? I don't know if I can answer that right now. It's a difficult risk to take. You could certainly make the argument that the developer should take that risk, and the developer, when you build a plant, you should think, are other plants going to come in and make my plant less valuable in this region? Or is a new transmission line going to go up? And when I choose to where I'm going to build it, so now I change my mind. I think the developer has to take that risk. Okay, so what we did much earlier, I'm not going to go up there and find it. We looked at Norway versus Germany, and we looked at all of these prices. What I'm going to do here is I'm just going to open this file that I put up there for you. And if we, in this file, it's just so amazing, really. I'm sorry. If I compare ERCOT, it didn't even, I had to send an email to go to their website or some crap like that. What bullshit. Sorry about saying that. But if I have a couple of prices here, they have a system price, and let's go down here's what I did in this thing. You press control down. Let's go to 2019 maybe. And let's compare the price in Denmark here. Oops, we've got some negative prices. And let's compare that to the price in how about Germany? Okay. And we go up here, and just by having that data, you want this data. It's so wonderful. And then if you have this data, sorry, lawyers, everybody, sorry, you need to do just to have a couple of little Excel things, and then you can see, oh, what's going on. These prices, they kind of follow each other really closely, but then we have negative prices in one region and not the other. Oh my God, is that cool? Because especially, I think I took Denmark, I hope I did. When we do that, then we can start to see, what's a real market in renewable energy going to look like? And then if you really, now I didn't, what I'm trying to do is fix some things I really screwed up in this class, but more importantly, I want to market this so I don't have to go through these assholes who I deal with all the time. The worst of all is this Redcliffe, the worst ever. Oh, they suck. Okay, I want to do it myself. Okay, and we'll have a class on this, and we'll go through some of this, and I want people to be technical and play with the data. How could you not want to go underneath and really figure out where everything is coming from? How could you not want to do that? I'm crying again. Now, what was I saying? God, I'm losing my train of thought. Okay, I totally shit. Okay, I'm gonna just continue. Okay, now when we so let's go back. Let's go back. Oh, I know what I was going to say. I was going to talk about renewable. Imagine a case where you have all renewable, all wind, no, all batteries and wind. What a merchant price is going to look like. There is no marginal cost. There is no plant that you can dispatch that turns on and off more. And there's no supply curve. And somebody can say, that supply curve in demand. So if that's ancient history, you're talking you're talking about a Crendungeon-y old, whatever, that's not a word, old Cremungen or something like that, utility man. Well, okay, right now, the reality is we dispatch on the margin. We dispatch maybe gas or something related to gas. There's a high correlation, even if you dispatch some coal. I'm sorry about that, but related to gas, there's some kind of, when you meet the demand. That's, again, you need to understand that. If you imagine, now just be quiet for a minute. Just take your mind away and just say, okay, let's pretend we have batteries and wind and solar. That's all we have. Well, there's no marginal cost. There's nothing that if you turn your lights on, and remember, that's the whole reason we make merchant markets, is when you turn your lights on, you want some consumer behavior reaction to that. Somebody told me that in the class. It was kind of brilliant the way she said it. I can say that. If you don't react to prices, well, why make a market anyway? You can make a market to make the supply more efficient. But then if we have all batteries have no marginal cost, you don't have fuel cost when you turn it on and off. It's a big fixed cost. There a little degradation that changes. Okay, fine. Solar and wind don't. Solar doesn't have marginal cost. Wind may be tiny bit, tiny. Oh, okay. And most modelers don't put it in. So imagine we're in a situation where only that, and then we have we want electricity, and a bunch of us want different amounts of electricity, and there's no marginal cost, and we can produce, if there's sufficient capacity, we can produce it all. Well, it's very hard to start imagining that market. What you almost have to say is, okay, I want electricity. I'm going to almost have to go to a wind farm and schedule that, make sure I get that electricity. And a wind farm is almost going to have to do something like maybe an airplane or something. Say, I need a fixed price, and to imagine that very different market is really tricky. And I still didn't do it very well. Maybe somebody can comment on that. Well, whatever. Nobody ever does. Now let's go back to this, and here are you just go to the ERCOT website, and I didn't take every single year because I was too lazy, and this is just studying the history, and then we can say, 2021 is when we had that enormous winter spike. But I took the average for the whole ERCOT versus the other ones, and the big deal is to see how these margins change. Look at this LZ West or whatever. Here's the margin in 2021, in 2010, in 2042. Now I found this thing somewhere. I forgot where. It's just a little expert somebody did, and this was the problem. And if we imagine what happens, we have two wind farms, I think they are. I'm not even sure what they are. And in this one, they had expected a basis difference, both of them, that was fairly flat. This one took a hit. Who knows why? Who knows why it would be negative like that? Maybe the demand was going down. I don't know. Maybe there's some outage for some big factory. Who knows? This one, there's this trend down. And if you're selling power at a node, that's at a place that's not in a place where you buy and sell a whole lot of power that NYMEX wanted you to do, then you're subject to this kind of risk. And really, it's hard if you're going to make one of these financially settled costs, and you read that NYMEX thing, which was quite right, and they've got people who've been working in the market forever writing those kind of little blurbs. You've got to take this basis risk. This node is where everything. I mean, the hub is where everything is going to be traded, but you actually sell power here, and you can't hedge this difference. And that's an example of what can happen. And this just takes that data and shows that there were some very big changes. There's the risk really you're facing as a developer if you're selling here at the, let's call these the nodes, and there's the hub. These can be hubs too. But if you're selling at the node and the financial settlement occurs at the hub, you've got this basis differential. And if it was all fat, who cares? Because you've already priced it in. You've already figured out if you should build it here. The problem is what happens if a bunch of wind farms come in and that supply and demand changes. And that's where we had started. Okay, now let's go to the different kind of, let's move to part 3. Oh, this irritates the heck out of me. Oh, Bloomberg said it's this, or level 10 said it's this. So you get some kind of price. Okay, now I've already talked about this. With a swap, if you define it somewhere else, some contracts have a notional amount and some have an as generated amount. That's that, period. Okay? And then we'll talk about the exact structure and work through some of the contract terminology in this video. Okay, that's okay. But if you think it's just as easy to get somebody to give you a financial contract where you don't know the output, what are you? I don't care. Whatever. What are you thinking? Really? Really? Okay, we should find some big, whatever we call this, midstreamer. We should find some midstreamer, and they're going to give us the same price if we have a contract where we fix the volumes and when we don't. I'm looking at these fixed streamers, our great friends. Okay, all these people who will buy and sell, they're going to make a market. They're going to go to that. They're going to basically be the like the NYMEX. Okay. I probably said that wrong, whatever. Okay. All right. You think you're going to get the same price. So I tried to study this, and it was really hard to do. First of all, here's level 10 of Bloomberg. Okay, the price goes up. Here's the price of wind. It's down here, and then in the U.S., the PTC went away, and the price went way up to whatever. That's not damn it, because the scale. Why would you make a graph that doesn't start at 0? I don't know. It's really distortive in a way, but whatever. Maybe they're okay. All right, and then the solar, we don't have the recent times, but it started going way, way up, even though the pricing of the panels in China did not go up. Okay, but that's now you can't buy them from China because you got these tariffs. You have these tariffs, okay? There. But what is this? This is meaningless for me. This is damn meaningless. Are they talking about a contract that has a volume risk, output risk, or not? Are they talking about a contract for difference or a swap? If we use this terminology, notice I put different terminology on it here. Okay? I don't know. And if Bloomberg says, oh, it must be right, okay, because we paid all that money for Bloomberg. And I've seen how Bloomberg computes betas and everything else. So I was able to find a little bit of data. I don't know where I found this anymore. And they had specific contracts, and they told us, which was really cool, whether it's a contract for difference, and the way they defined it, contract for difference has output. It's not a firm output. And so here are some of the things. We have some contract for differences. Notice that the contract for differences sometimes had a price in the day and a price. This would be the price at night and a day, and that price changed from year to year. So when you do a contract for difference, because you're not seeing the output, you're almost resolving that by making this. But then there was one contract for difference that just had a boring old fixed price. This one had an enormous difference. And what I did was just take the average here, which is really bad. Okay, I didn't know what to do. And then the swaps had just a fixed price. Some of them might have had different inflation. And these are the kind of the term you get in years. And basically they're all trading except for one at the hub. Okay, the developer is taking that basis risk in every single case. And maybe they should. And here I try to arrange it a little bit by putting some of the dates together. So this is 2015 in ERCOT. There were different regions in ERCOT, but I just put it in ERCOT. That's the Texas place. And there was the contract for difference had a higher price than the other ones. Now, that kind of maybe cheated, but that's exactly what you'd expect, because there's no fixed volumes, and you might be producing more or might be producing less. How are you going to go to the other side and kind of hedge all that away? And that's why we started looking at prices. And here's another one. This has a bigger range in dates, and here are the contract for differences and the swaps. And okay, this is what I would expect, and maybe I fudged the data a little bit. That's okay, because I used the averages. And here's the one in another market in whatever MISO is. Is that middle or something? Okay, whatever. And they're different dates, so you really maybe they're totally uncomparable. But it seems that the contract for difference is when you don't come up with a specific volume had a very different price. So let's just go through kind of how this really works. Instead of just BSing around, let's go through the details. And that's what I was really criticized for, and rightfully so. Okay, and we're going to go through the swap and contract for differences a little bit more slowly. And the big question is, how do you determine, if you have a swap, how do you determine these notional amounts? Okay, again, if somebody says, oh, I'm a big developer, I'm just going to get a contract for differences, I don't want all this business of notional amounts. Well, screw you. You're going to pay a higher price. That's fine. Do that. But let's try to understand it, and let's try to understand what it really involves, okay? So if you determine a notional amount, you have to set, like you set the debt in an interest rate swap. Once you set the debt, here, if we set the amount, and then if we happen to produce more in a wind farm or produce less, okay, well, then we're going to have to go to the market and buy power, or if we produce less, we're going to buy the power, produce more, we're going to sell the power, and the big enormous question is that creates merchant risks, first of all. And secondly, if you've got a wind farm, it's pretty obvious, and that's why I went through that Denmark wonderful kind of case. When we probably sell, we're going to have more output, wind, and other people will have more wind, and the prices will be lower when you sell. They'll be higher when you buy because you need to buy when you're not producing. That means other people aren't producing. Whew, I need to take one breath. Okay, so then, what I did in this, I did something I shouldn't have really done. Maybe I disguised a contract, and I put it right on the website, and I changed the names, changed everything. But there's a big deal. You go down to the pricing formula, and it says you find a month, and there's a settlement amount. Okay, and we got to understand how this all works together now with corporate PPAs. There's a fixed price and a floating price. And if we're the developer, we get paid the fixed price and we pay the floating price. Now, if that floating price was exactly the same as the floating price that you received when you sell the power in the market, you're left with a fixed price. We have to do a diagram on that. I can't see. So here's the fixed price, and they say what it is, and then they say, okay, it's going to be a product of the interval quantity. We have to find what that interval quantity, whether it's a output you produce as an output, or whether it's notional, and you have to figure it out. And then they talk about the floating payment, and it's the floating price for the interval, and we don't know if this is at the node or the hub. And then they get a fixed price that's escalated, not at the rate of inflation. No, inflation risk here is taken. If the inflation is really high, the developer should want a higher price. If it's low, so they can keep their real rate of return the same. It's such a big deal. This inflation risk is idiocy. Why wouldn't you just keep it the same in real terms? Well, they don't. And that means if the inflation rate goes up, the developer does badly because they fix the price. If it goes down, they do well. So the developer is taking the inflation risk and not the other one, whatever, the settler, the midstreamer. Interval quantity means blah, 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 energy generation. That means it's like a contract for difference. It's not a swap. Actual energy generation. It's actual energy generation. And they also say somewhere else that this settlement point is at the hub. So this project took a basis risk. It took an inflation risk. It took the transmission risk because it's priced at the hub, not the node. It took it did not take the quantity risk. So I try to do these little diagrams just so you understand. And when I do these diagrams, I insist that we do the money. So in this case, we were just doing this, and this was a buyer who was paying you a fixed rate, and you were paying him or her a floating rate. And this was the contract we just looked at. Outside that contract, we're selling at the hub. We're getting this green area. This green offsets the red area. This goes away if you didn't have the basis risk. We have basis risk, and then you end up with a fixed price. That's what you want. You have to kind of look at it a little bit more carefully, and I didn't do enough of that in the class. I totally agree. And the midstreamer, he could use NYMEX. I'm sorry. So then we go, I'm sorry. Then the buyer has to do the same kind of thing here. Right now, the buyer is just all they're doing is setting a contract, and they're paying fixed, receiving floating, but they want to actually hedge themselves. So they want to offset this merchant risk, and they want to actually pay. I've got this backwards now, because if we did it from the buyer, we do green and red differently. The buyer is taking the fixed versus floating risk. How's that? That's enough. And then so the buyer could go to an intermediary, okay, and then they could do a swap with the intermediary, and that would mean that the buyer ultimately would just pay a fixed price, and that floating price that they pay to the other person is offset by the intermediary. I hope I got this right. Now let's use a swap contract. This is way too small. We can't see it. So here's how a swap contract works if you really look at it carefully. They use 80% of the forecasted production. Why do they use that? And then they say we use a fixed shape. And they say we use that based on an in-demand engineer 12 by 24. What next? 12 by 24. 12, it must be months. 24 must be hours in a day. So what they must do is go and figure out what a typical wind shape is, to figure out how much we're going to fix the volumes of. If the wind always produces at night, we're not going to fix that at night. And that floating price we have is an hourly hub price, not a node price. So we take the transmission risk. And then we have the same sort of settlement here, but this time we use a notional volume. We take fixed, and we totally ignore the tracking account at first. We take the fixed rate minus the floating rate. That's just what we had before, except this one we have notional volume instead of fixed volume. And the notional volume is 80% of the forecasted production using this fixed shape. So it looks all kind of complicated. And how would you go through this? And what I say, and the way we're going to do this, is make a hypothetical transaction in Denmark where we can get wind data and see how it really works. And ultimately, when the developer gets the cash flow, it gets the merchant cash flow, and then the settlement. But the settlement has, this is not really good. He really gets the 80% fixed, and he plays floating to the market anyway. And then the rest of the 20% he gets on the market. Now, it gets a lot more complicated than that, unfortunately, but it is interesting, I hope. Okay, so we're going to use some data. Now, the first thing, let's understand what this 80-20 is. Okay, why is this 80% of forecasted volume? What's the 20% business? Well, here's the other thing. If you're going to be in renewable energy, you got to understand what norm inverse is, and how to just compute in a minute, in a second, in a millisecond, the P90, the P99. And if we have a typical standard deviation of 10%, and even if we're a lawyer, we're not afraid of standard deviations. And if we have a capacity factor, then we use 8760 and get a production amount. We take this production amount, take a standard deviation of 10% of that production amount, and then we use norm inverse, and we find that the P99 value here relative to the P50 value here and here is about 80%. So you call that a P99 hedge, but you've got to be so careful. It's unbelievable. You've got to understand just a little bit of statistics before you start throwing around, which I did. I made every mistake, I assure you. Before you start throwing all this around, you've got to understand what it really means. Okay, and I have not kept the track of the time, and we're is this really true? Oh no. Okay, I'm at 54 seconds, no minutes. Okay, that's okay. I'm gonna just keep going. That's what I'm gonna do. Now, if we go through this, and here's what you can do. You can go to Nord Pool website. I'm really a salesman for them almost because I had to pay money for them and I'm trying to get a return on my investment, which I can't do because I never make any money on anything. But that's a different subject altogether, isn't it? I'm going to start teaching this class and we're going to have some good discussions, and I'm not going to do it with some Redcliffe or somebody like that. Okay. Now you can get the annual capacity factors. We can't quite get them because they don't have capacities, but we basically know there's going to be some hour. I'm going to guess some hour where every wind farm is producing at just about 100%. So if you take the maximum of the wind, hour by hour wind for a year, I'm going to call that the capacity. Okay, maybe it's not exactly right, so don't criticize me. Or maybe I could really go to Denmark and figure out how much is in Copenhagen and the rest of the country, but I did that. And then I get these capacity factors. I had to fix this one, by the way. This is a little bit off. And this is the range in capacity factors annually that goes up. And if we take the average capacity factor and the standard deviation, we can compute a P99 with our our norm inverse, just like we did before, and we get about the same 80%. I loved it. For once, something actually worked. This was annual, though. And then you can do the same thing monthly, and you use a sum if on the average if rather to compute the capacity factors on a month by month basis. And when you do the standard deviation, and this always happens, and it should happen. It absolutely should. And if you don't understand that the finer the time interval, the bigger the standard deviation. The finer the, so if you did even a beta, I'm doing this on something totally else that I'm going to make a bunch of videos on. I've got so many videos to make. I'm sure you're going to not watch any of them. But if you take standard deviations, the one thing to know is the standard deviation, there's volatility, all that stuff. Once you take a bigger period, it averages out, and that's especially if you have mean reversion and they're independent. So this standard deviation was 2. This standard deviation on month by month. Isn't that fantastic? That you can get this hour by hour data and then relate it to the prices. That ERCOT was shit compared to this, really. But when you do that, then the P99 is dramatically worse because we have a volatility. If here we pretended the P99 was the average, we have a whole lot of that should happen in 1 in 8 years. This is about 8 or 9 years, and we have a whole bunch more. Okay, and that's just natural. We just need to understand some basic statistics, and then if we do it hour by hour by hour, which is really what you're doing when you design this stuff, then the P99 is negative, or I think that's P99. I should have. I made another mistake. Okay, whatever. But you can. So in this now on the website, because it's so interesting, I put all of this stuff in here. Okay, there are a whole bunch of graphs, and we'll go through this, but. And this is something else I just want to emphasize, which maybe you don't care about, and I'm ranting on it too much. Get the data in Excel. Don't trust other people. Get underneath the data, even if it's a pain to do it and you're going to waste some time doing it. God, compared to say, oh, Bloomberg said this. Oh, Level 10 said this. Come on, get the data and figure it out. Then you'll really see how the whole thing works, and that's why I put all that stuff here. Okay. Gosh, I gotta calm down. So then you remember it said that we compute the shapes, and then you use something called average if, right? And we take the average for hour 1 to hour 24 by 12 months. These got 12 months, and it's so cool. And you get that data from the wind. Look how much different February looks compared to May. How's that? Or June. June's kind of flat. This is more at night. March, for some reason, is this. These are these shapes. Now, maybe when you design your wind farm, there'll be different shapes, but it's fascinating. I never really saw those shapes. If you get the data yourself, you can do it. And this is what you're going to do. These are the shapes. So what you're going to do here is, and now I used capacity factor for this. So here's the capacity factor by hour. Whoops. by hour, and that's what we're using here as the shape here. So instead of just mumbling on and BSing about this crap, I've tried to really do it wherever I did this explanation. Find a contract and then really work through how it actually works. Okay, and that's how we do the notional volume, and it's based on 80%. So we're going to take that capacity factor, reduce it to 80%, and we're going to fix the prices based on these capacity factors. And we're going to, these are the P50 capacity factors, and we call it a P99, even though I just proved, I hope, that it was nothing to do with a P99 on an hour-by-hour basis. But that's what we're going to use to fix our notional volume. And we have to know how to do it. And the wonderful thing about the Nord Pool is that when we do that, so I'm reducing it, okay? And when we do that, then we'll have the actual hour by hour by hour by hour capacity factor and the shaped capacity factor. And then we can take that difference, multiply it by a megawatt quantity. But I hope you can start to see how it's really, really working. And then this is the hour by hour. So what we can do is we can put see these actual capacity factors up and down and up and down. I think I'm going to have to, what am I going to have to do? Make 2 parts to this video, something like that. And then we can take the difference. Here is the shaped capacity factor, which is just from right up here. This is the shaped one. And here is the actual capacity factor hour by hour, because you have the hour by hour win, because I love that Nord Pool website. And if we have too much, and I purposely had some interesting things happen, if we have a capacity factor where, let's find one. Okay. Here, this is whatever. This is 32 is the shaped. We only produce 20. That means we got to go and buy capacity. And we can express everything as 1 megawatt. It makes it so much simpler when you express everything as 1 megawatt, because if you have 1 megawatt for 1 hour, you take it over 8, 7, 60 hours, and you have 1 megawatt per year. And euros per megawatt per year. That's what you do with all of this stuff. And then in this case, the opposite occurred, where we had the actual capacity being really, really high, and the one we used in the shape being low, and so we have enough to sell. And look what we can do. In this, when we do this, it's actually, it took me, an hour or 2, whatever. It took a little time, and I put that on the website. But you can do it if you have that data. You can do it. Okay, you don't have to go get a PhD or something like that. Okay, and then what you can do is do a sum if and get the total amount you sell and buy by month. Now, I purposely took a really bad month, and we're purchase here. Let's take this one. We have to purchase this much from the market. We're selling this, even though it was a P90, because because of the price difference, we got stuck. So we got more negative numbers for months than positive numbers. And that's because the prices were lower when we're selling and higher when we're buying. Okay? And then we can do that. Here's what it is. Now, it was very variable over time. So if you wanted to really look at your merchant risk, isn't this what you should be doing? Isn't this looking at what the prices, what really happened to the prices over time? Isn't that what you should be doing? And then you sum it over a year. And I got tired by the time. I'm not showing you the little output, but this was really interesting. So we were with this 80-20 or P99 hedge, and we were having positive values here. Now this, when you look at this scale, it should say euro per a megawatt per year. So this is 50,000 euros per megawatt, or 50 megawatts, 50 euros per megawatt per year. And this was not that big a number. And then it went really positive in the big 2022 year, and then this is not really a full year, but the other thing you can see, there was a trend downward, and maybe that's because there's more and more wind in the market, or there's more kind of a risk that when you're producing you get a low price. These are the kind of things you can really do with data. You're doing a few things: seeing some trends, seeing the magnitude, and you're understanding how it really works. Now I'm gonna call this part one. I'm gonna stop and call this part one.